The last video that was posted was looking at potential turning points and was really looking at distribution and market profile based concepts. Today, after payroll last Friday, we have another brick in the armory, as it were, and today we're going to look at quantifying divergence. Now, divergence is something that can be a very abused term. The concept is that if the trend is going in one direction and momentum is going in the other, and you can see lots of commentaries, lots of video, all sorts of things that will tell you that there's divergence appearing in a trend, which suggests that the trend will end. Well, the reality is that only the very strongest of trends do not diverge, and so it is a fact that nearly every trend, whatever the time frame, whatever market it is, will always diverge. And as we know, if something always happens, then the chances of you managing to build things around it that are going to really help you is very unlikely. So therefore, the ability to quantify divergence in a way that is relatively rare enough to still make sense, believe me, is extremely difficult. I spent the best part of 10 years on and off getting to the point where I now have divergent signals that are used in the iTraders commentaries that I have sufficient faith in and have tested thoroughly enough to say that when they do appear, especially if they connect with other types of analysis, I can look to call turning points in the market. Just going to refer to the report written on the for last Friday, the payroll day, and on the notes it says that the move lower has left behind divergence, and the reference point is the high for that day. And if we now look at the DAX on a daily chart, this is just an active continuation. This red arrow is indicating that point where that divergence pattern had actually appeared. Now, certain divergence patterns, because they took so long to develop, such as this black square here, are so rare and so powerful that we don't actually necessarily tell you how we create them. And their rarity means that normally on futures, certainly on historical charts, you could actually wait years before seeing them. However, on stocks, if you're looking at stocks, then you'll get signals on a far more regular basis. The code that shows what that red arrow is and what the divergence is actually relatively simplistic and was the original signal that I first came up with probably over 10 years ago. All it's basically saying is that the market is making a 9-bar high and the RSI, that's the code at the bottom there, is making a 3-bar low. Very, very important point is the fact that I haven't put any value on the RSI itself. I don't care whether the RSI is at 35 or 95. In fact, if it was at 95, I'd actually be more wary of the signal, because very high values of RSI mean that the trend is actually explosive and very, very strong. The reason why there is no value on the RSI is because it opens up the possibility of getting divergence as a continuation. So in other words, the trend could be down, we have an opening that's making a 9-bar high, or the high makes a 9-bar high, and then we sweep lower and actually end up making an outside bar lower, so we could have divergence as a continuation. Relatively rare, we're not really looking at that today. What we have here though is this signal that appeared on the DAX on Thursday. We can see with this black square here that we had a signal just after the lows were made, and it wasn't made at an absolute low, and that's one of the key things about how I use divergence and has qualified it properly. The key thing is it's not necessarily the relationship between absolute high lows that create that divergence, it's the patterns within them. Other ways that they can be qualified is via such things as the range deviation pivots, and on that day we had a significant close beyond the third deviation up, so that gave me a very, very strong indication that the trend had changed. We had an expansion of range and we had a very rare and powerful divergence. We were also oversold based on the KPO, so this is the low of this trend cycle, or there's one more low to come, and it fulfilled that criteria. Now if we look at the chart, payroll day saw us come up towards those highs, And to negate a divergence pattern, what needs to happen is you can have two ways. You could say that price broke the high of the pattern or made a new closing high on that pattern. Personally, I prefer that closing high, and a good example is on the Dow. If I just call up the Dow, price actually closed just fractionally above it, but it was almost at the same point. It was a very, very late move. Here we can see we had another divergence on the lows, and this is using a derivative of the KPO to create the pattern. So here I had two different divergence patterns on the same day, on both the DAX and on the Dow, and that was a very powerful signal as well. Now the reason why that pattern on the Dow has not been negated is to do with the S&P, and on the S&P the market did not take out the high, so we had a very difficult decision to make based on what happened on Friday. One market just about closed above to new highs, but the other markets, including the Euro stocks, did not. On this candle here, we can see that we had a full signal, and so it's important to understand different ways that you could confirm signals. Now that we've had this signal bar here, ideally what I would like to see is a close below the low of that bar. That would be the first point that would indicate to me that yes, a top has formed and now we're starting to break down. I'd also like to see the market break certain market profile based levels of support and resistance. So here we did actually close below, and then we just got blew out the following day. When trying to qualify divergence, just going to show you some examples of how this looks at the trading time book, and is specifically from chapter 4. And this shows that if you can make divergence sufficiently rare and powerful, not only can it be an exit point for trend following systems, it can also be a counter trend system. This is the statistics from January 2000 to 2001, and then again in 2004. And this was a vicious bear market in the S&P, and it's taken the S&P 500 and it's the buy signals. And accuracy can be up in the 60% on a raw basis, and also show some very large gains. If I then take that same pattern and put it in areas where there was sideways on the same portfolio, not surprisingly the accuracy is even higher. We're getting into the low 60s, and there's not as many trades in that period, but again percentage gains are very, very high. It's important to remember that there's no stop loss on the signal evaluator, so it's just giving us raw results, as it were. Just returning to where we are today, this is the E-mini, and we're taking the highs from that day, and this is the current day from 7 o'clock London time. And what I'm really looking for here is the fact that so far, from a couple of days ago, price held the short-term control that was really at around 899, and this support level at 901 to 899 is still very important. So for divergence to really be confirmed, I need price to start trading below here. In the meantime, there's not a great deal to hang on to. We have some resistances right up at the highs. However, if I was to look at the FTSE, this is the distribution from the highs in last autumn of 2008, and now the market has been coming back up again, and this has been the high of the trend so far. And what we can see is the fact that effectively this rally really went to what we call the top of the distribution at around 4,500, and so here I'm connecting the resistances, and then divergence has appeared afterwards. So in conclusion, divergence needs to be qualified properly, otherwise it's a very dangerous tool. It is more useful when it's connected to other analysis, and once divergence has appeared, we really need it to break some key levels before we can say that yes, it's definitely working. So there's still a bit of work to do before I would definitely call a top.